Learning Objective 4 walks us through the computation and evaluation of financial statement ratios. We're going to look at some of the most commonly used as we walk through this analysis. Once again, remember that you don't have to be an accountant to utilize ratios. What we are doing in this final series of lectures is, even if we are management, marketing, financial, economic related, how do we take the information that is available from these financial statements and turn that financial statement data into very useful information that we can use to analyze our organization? And so we're just analyzing some different tools that we can use to do this, and even managers will be expected to calculate these ratios, and certainly to analyze and interpret them, even if accountants are preparing them for you. So let's walk through some of the basic ratios that we have. There are some different categories of ratios. We'll look at the ratios that we use to determine how to pay current liabilities and long-term debt. We'll look at how well we're moving our inventory and collecting our receivables. We'll look at profitability and investment ratios. So we obviously need financial statements to get the data that we will utilize in these ratios. So if you want to pause at any time to go back to these slides and see where the numbers came from, you certainly can. I will also provide these PowerPoint slides for you so you can pull them up if you want to be looking at the financial statements as we calculate the ratios moving forward. So we have the balance sheet and the income statement for Smart Touch Learning. And we begin with, what ratios would we use to analyze how well a company can pay their current liabilities? And one of the first is working capital, right? And this is really one of the most basic ratios. It's simply, if I take all of my current assets and subtract my current liabilities, this is the working capital that I have available to me. And in a particular situation a couple of years ago, we were working with a golf course actually that had mentioned that he really needed $250,000 in working capital to maintain that facility. And there were a couple of people on the board that really didn't understand working capital. They're like, the course has to be worth significantly more than that, and has to have assets worth significantly more. Yes, working capital is simply the amount of, as it says, working capital that the company needed to be able to maintain its daily operations. So if I take my current assets, my cash, my receivables, my inventory, and I subtract any current liabilities related to those, my accounts payable or short-term debt, do I have enough current assets left over when we back out these current liabilities? And in his particular situation, he knew that he needed around $250,000. When we're analyzing this for companies, we can look at that working capital. Is it increasing? Is it decreasing? Does it meet what's required by this organization in their budget? We can also look at the current ratio. The same two items, we're looking at current assets and current liabilities, but in a in a ratio instead. So what I want to know is, do I have enough current assets to cover my current liabilities? And instead of seeing the raw numbers that we saw here, 110,000, 120,000, what I'm going to see is how many times my current assets will cover my current liabilities. So 1.87 times in 2017, 1.85 in 2018, we can see that it is decreasing, but it is well above the industry average. And so one obviously would be ideal, and we would like to, and anything below 1 might concern us, but also we need to realize, when is too high? When is the number too high? When am I sitting on too much cash? When are my accounts receivable too high? When am I sitting on too much inventory? Right? So understand, you can you see the calculations, you'll have the calculations when you're tested on it, you will have these tools available to you when you're in business. So understand what makes a ratio change. In order for this current ratio to increase, I either have to have an increase in assets or a decrease in liabilities. Is an increase in cash a good thing? Is an increase in accounts receivable a good thing? What about inventory? Let's look at liabilities. Is a decrease in accounts payable a good thing? What about a decrease in short-term liabilities? We have to understand what changes are driving the ratio and if those changes are in the long term good or bad for our business. Now, following the current ratio, we also have what's called the quick ratio, which simply backs out inventory. So the ratio here says cash and equivalent, short-term investments, current receivables. Notice the total current liabilities remains the same. The quick ratio simply removes inventory from the current ratio formula because inventory is not as liquid as cash, accounts receivable, cash equivalents, and short-term investments. So even though our formula says add your cash equivalents, add your short-term investments, add your current receivables, you simply could have said total current assets minus inventory, and we would have the same formula here. But the quick ratio simply is what it says. It shows us a little better how quickly we could cover our current liabilities with current assets excluding inventory. Right, so the next category is how quickly can we sell our merchandise and collect our receivables. And so some of the ratios that they've given us here, inventory turns. How quickly can I turn my inventory? Well, let's look at this one. Cost of goods sold divided by the average merchandise inventory. This is usually beginning of the year plus end of the year divided by 2. And in 2018, our company was turning their inventory almost 5 times a year. But if we compare that to the industry average, it's very low compared to 28 times. So does that mean we close our doors and stop business? No. The industry average may be compiled by Fortune 500 companies, and we're just a small privately held company comparing our inventory turns to companies that are larger than us. So realize what your comparison actually is when you're comparing to the industry average or industry norms. How many days does it take us to sell our inventory? 80 days compared to the industry of 13 days? Well, obviously we'd like to be able to move it as quickly as we can. Why are we so significantly different than industry here? What is our gross profit percentage? This is in your vertical income statement. It is simply gross profit divided by sales. We can see, once again, comparison of where we are at 40% compared to the industry average of 43%, not so bad. How many times are we turning our receivables in a year? And once again, it is simply a tool. Dividing credit sales. Credit sales are driving my accounts receivable. So how quickly am I collecting the receivables that are being generated by credit sales? We would like to collect as quickly as possible. On the other hand, if other companies are selling to their customers and giving them 60-day terms to pay off their credit, and we come along and demand 30-day terms for similar products, then our customers may purchase from someone else because they have a longer period, basically interest-free, to pay for their product. So we would like to collect as quickly as we can, but we have to understand what decreasing this number could do to potential sales. And then we'll look at how many days our sales are out there in receivables. So this is simply our number of days in the year divided by the turnover ratio that we just calculated to show that on average we're collecting our receivables every 42 days. Well, what's our policy? If our policy is 30 and it's taking us 42, this could be a problem. If our policy is 60 days and we're collecting in 42, then maybe we are pushing our customers too hard. What about ratios that measure our ability to pay long-term debt? We call these debt ratios. And the number one ratio here is simply called the debt ratio. It is total liabilities divided by total assets. And what does it tell us? Simply then, it tells us what percentage or what proportion of our assets have been financed with debt. Ideally, we would like for this to be 50% or lower, and we can see that we were at 54% in 18, we've dropped to 50% in 17, our industry average is 69. So in the industry, people are using more debt at this point than we are to finance our assets. That's a good thing. Okay, unless we're in an economy where interest rates are significantly low, should organizations be taking advantage of the borrowing interest rates? Then we have debt to equity. Instead of measuring, as we did here, liabilities as a percentage of our assets, we were looking at liabilities as a percentage of our total equity. And so as it tells you, we can see that our liabilities exceed our total equity. So our organization is more significantly leveraged with debt than it is equity. And that's what happens when this number exceeds 1. This will impact how likely creditors are to lend to me in the future. This will impact how willing stockholders are to invest in my company. And once again, we have to understand what the debt is for and how well it is being used before we can determine as well if these are good or bad numbers. Okay, how many times, the times interest earned ratio simply measures our ability to pay our interest expense. 4 times versus 8 times in the industry. So we simply take our income, add back our income tax expense and interest expense. So our income before taxes and interest, how many times could we cover our interest expense with that net income? Obviously, a banker is going to want to see 1 or 2 or above in this particular situation before they're going to be willing to loan. And then profitability. We've looked at the profit margin, simply net income divided by sales. Is it increasing or decreasing? How does it compare to the industry? What about return on assets? We looked at this to some extent, when we were evaluating our investment centers. How well are we using our average total assets to generate net income? This is our return on our assets. We also can turn that into, a turnover ratio, how many times we are turning those assets. Once again, this is really only going to be good if we're comparing it to what's going on in the industry or what our trend is over time. And then rate of return on stockholders' equity. And notice your text says this tells us how much income is earned for each $1 invested by my common shareholders. And so we can break that down into percentage, or for every dollar that our stockholders are investing, how much return are we generating for them on that investment? And then just a phrase that you might hear if you end up in the financial field, this trading on the equity, and it simply says when a company has, note, a higher rate of return on stockholders' equity than its rate of return on our total assets, this is called trading on the equity. And we're simply saying that trading on the equity is earning more income on borrowed money than the related interest expense. So it's showing that we're generating higher returns than what we're borrowing, and we can generate potential increased earnings and potential dividends for the stockholders of our organization. And we kind of measure those our investments by earnings per share. Once again, if we want to know basically the amount of income that is being earned per share of stock instead of per dollar of stock, we've got earnings per share. So in this particular case, we are earning $2.60 per share for every share that's been invested in our company, $4.80 in 2018. Doesn't mean we're going to turn around and pay all of our investors $4.80 a share. It simply means that's what we have earned per share that has been invested in our organization. Okay, we can look at a couple of other investment ratios. The PE ratio is the number one tool that's used here, which simply says, what is my market price divided by those earnings per share? And so we see, once again, 2017, 13.46 compared to 2018 of 12.5. Both of these, it is decreasing and it is lower than the industry average. But as I mentioned on the current ratio, think about what could change this ratio. What could make it decrease? Well, if earnings per share increase and the market price per share does not, for whatever reason, then this ratio can decrease. On the other hand, if earnings per share decrease, Simply, if the earnings per share have gone down and market price happens to stay the same, then we could see an increase in the PE ratio, which is not necessarily a good increase. You have to understand what's driving your changes. And let me go back here. Earnings per share. What could make earnings per share go up? Let's break it down even further. Well, either net income goes up or the number of shares that we have outstanding goes down. Okay, are you with me here? Earnings can go up, which is a good thing, or the number of shares that we have outstanding can go down. So what I'm telling you is that a company can increase its PE ratio simply by going out into the market and buying back its stock as treasury stock. So understand the changes that are taking place, and all of this information can be found in your company's financial statements. If they are buying treasury stock back, we can see it in the statement of stockholders' equity. We can see it in the balance sheet. We can see it in the statement of cash flows. So you have to understand how to read financial statements to be able to pull the numbers out that we need to do analysis of our financial statements. There is the dividend yield, which tells you the percentage of a stock's market value that we actually do return as dividends to shareholders. We're not required, companies are not required to pay dividends, but stockholders do want to see either an increase in the value of their shares of stock or some return via dividends. And so the dividend yield is simply what is our annual dividend per share, and divide that by our market price per share. Okay, so we've seen some of the most common, the dividend payout as well. Okay, once again, it's just the instead of a dollar, we see percentages, dividends per share divided by earnings per share. So we've seen some good tools, the vertical, the horizontal, the ratios, but you have to understand what's driving those changes. Understand that when sales increase, we should see cost of goods sold increase, but not faster than sales. If we see a buildup in inventory, why is that happening? Are we building up for a massive movement of inventory, or do we have inventory that's growing old? If receivables are increasing, are they increasing because credit sales increased or because they are old and not collectible? So we have to understand the changes in the things that we are seeing in our financial statements and what happens to be driving those things. Now, the next few slides that are available, I'm not going to lecture over. I just want you to know that these are very good slides to break down for you the different categories. If we're looking at paying current liabilities, these are some ratios that will help. If you're looking at selling your merchandise inventory and collecting receivables, here are some of our activity ratios. If you're looking at our ability to pay long-term debt, then we're looking at our debt ratios. Profitability, we're looking at our profitability ratios. Investing in our company, so we have our investment ratios. So we have investors that will do analysis, and they want to know whether to recommend buying a company stock or not. We have creditors who want to know, if we back up, can companies pay? Are they profitable? Can they pay their long-term debt? We have managers who want to know, am I moving my inventory quickly enough and collecting my receivables as I should be? We have the treasurer of the organization who wants to know, are we liquid enough to pay off our current liabilities? And then everyone is concerned about the profitability, the manager, the investor, and the creditor. So these may be pertinent to all. So what I would like for you guys to leave this class with is the basic understanding of these calculations and which ratios are most important to you if you are a creditor versus a financial analyst versus a manager within an organization. If you are someone considering buying out or merging with another company, if you are simply deciding whether to jump into a particular type of business in the market, what ratios do you need to make those comparisons of whether these would be wise decisions? Okay, this is the end of the chapter. Please feel free to stop, take some notes, and go back to review the 3 tools that we've looked at: vertical analysis, horizontal analysis, and ratio calculation.